So very happy to see so many people and many new faces, many old faces from past events for our GAPLA online talk today. As there are a lot of people who might not know GAPLA, just as a brief introduction, GAPLA and the German Australian Pacific Lawyers Association is a platform for lawyers from Australian, Asian and German-speaking jurisdictions to connect over all kinds of topics. As you can see today, we're going quite technical, and we have Philipp Maume with us, who is a associate professor with the Technical University in Munich. His main research areas are the law of business entities and financial market regulations. He studied in Germany at Albert Ludwigs University in Freiburg, sorry, very difficult name, and then went on to study at La Trobe University in Melbourne, Australia, where he completed a Doctor of Judicial Science, and then returned back to Germany, where he's now heavily involved in his research and teaching on the influence of technology on the financial markets, and is also advising the German federal government and the European Parliament on these topics. So if we got time later on, we may talk about that as well. And other people you may see on the camera are my board colleagues, Claudia de la Cruz and Michael Cobras. And I think that was it for introductions. If you have any questions, Philipp, what do you think? Should we take questions during your talk, or would you prefer questions at the end?
I think it's the best to put the questions in the chat while I'm talking, but the best thing, I mean, the talk will be about 30 minutes, so I think it's best to answer these questions at the end, because otherwise it will just get quite bumpy.
Okay. So we let you talk and we collect the questions. So anybody who got questions, please put them in the chat, and we'll get to them at the end. Or if you're very keen, turn on your camera at the end and talk to us live. Just for information, we're recording the session. So if you wouldn't like to be recorded, please turn off your camera and just use the chat function. And Philipp, thank you for being here. Thank you for sharing that topic with us. The floor is yours.
Yeah, thank you, Juliane. Good morning, everyone, at least in the Central European setting. Good morning. So, hello, everyone. I've been a member of GAPLA for, well, quite a few years now, but I've never really been able to make any contributions. So it was very obvious that one day this question would get through to me, whether or not I would like to give a talk. And of course, I said yes. And I said, look, since my favorite topic is, or my main topic these days is fintech regulation, and in particular, everything related to the blockchain technology, this might be worthwhile, because this topic is not just very, very important right now. There's also a lot of media coverage these days, and there's also a lot of nonsense in the media. Yeah. And what I would like to do is to give you, over the next 30-35 minutes, a quick introduction of how these things actually work, because it's my experience that most lawyers have heard the terms. Everybody's heard the term Bitcoin, but nobody really knows really how it works and what the magic or non-magic behind it is. So I think this is actually a good opportunity to shed some light on these issues. I have to say, so this is not a high-flying talk for experts in the area. This is more laying the ground foundations to create some basic understanding. We can get deep into the matters if anyone's interested, however. So the European Union has, let's say, the reputation of being a little sluggish, a little leaning heavily on the side of being bureaucratic, and so on and so on. And there is some substance to this argument. However, in all fairness, in the digital area, the European Union is moving with remarkable speed, and the policymakers are actually quite determined. So if we take a look at what's happening or has been happening over the last years and the regulatory reforms that are currently in the pipeline, it's actually quite a lot. It's actually quite a lot. I've just, this is not a complete overview, but just to give you some ideas. Yeah? So last year, the crowdfunding service provider regulation came into force, and what is currently in the queue is the Digital Markets Act and the Digital Services Act. So this is mostly about platform regulation, so online platforms, but also social media platforms. We have a general regulation on artificial intelligence in the pipeline. When that will come into force, I don't know, but this is the first, let's say, comprehensive framework for AI regulation in the world. And since the European Union is one of the biggest markets in the world, this will have impact. Yeah? There are also rules for financial service providers regarding their technical resilience. So basically how to make technical services more stable. And this is what I would like to talk to you about today. We have 3 more reform projects underway. The main one right now is the markets and crypto assets regulation, which I will explain a little later, which is linked to a pilot regime on DLT market infrastructure. So you could say the MiCA regulation regulates crypto assets, and the pilot regime for market infrastructure, the surrounding markets. And in the back of the whole discussion, there's of course always the overarching topic on whether or not to create a central bank digital currency, which is also referred to as the digital euro. But this is more a project on the horizon because this is actually quite complicated. However, everybody agrees that if this digital euro one day comes into force, it will be blockchain based, which means it's squarely in the topic that I'm talking about today. So you see, it's a lot happening in the European Union. The first thing that I would like to talk to you about is what is actually the blockchain. The first term that's already a little misleading. People very often talk about the blockchain, but this is inaccurate. There is not the blockchain. There is just the blockchain technology. So you have to regard the blockchain as some kind of infrastructure. There are various blockchains out there with various protocols, functioning principles, underlying principles, and so on and so on. So the important thing is blockchain is a working principle, or is a certain way this technology is being operated. But what is this technology? The more accurate term is actually distributed ledger technology, or in short, DLT. And DLT is actually nothing so super sophisticated. DLT, if you look at Wikipedia, Wikipedia is actually quite good for these things. DLT is a digital database, and this database contains information, and this information is then tied together in blocks, so in storage units, and these blocks are tied together through certain protocols, certain cryptographic protocols, and because it's block by block by block, it's called a blockchain. So the thing is, the whole blockchain is just a database. It's a database that is distributed over a computer network, and that's why we refer to it as decentralized. So there's no magic or whatsoever, no voodoo about it. It is simply a database. But the interesting thing is, because this database exhibits some very particular, let's say, features, it makes it quite different from most other technologies that we have. And it allows us to come up with new use cases for business models and improve other business models. And this is what makes it quite special. I'm not one of these blockchain prophets who say that, oh, the blockchain will change our world. I don't think so. However, I think in the digital way, blockchain is arguably the biggest advancement or the biggest leap ahead in various areas since the introduction of the internet. So what are now the advantages of the blockchain? The first thing is, imagine you have a network of 100,000 computers. And the basic rule is, I have to simplify a little bit, that the data of the blockchain network, so the database, is either completely or to a certain extent stored on each network participant, which means the loss of data is virtually impossible. So we had a few months ago, we had an outage at some stock exchanges for a short time because the databases, so the servers were down. This is actually not possible in a blockchain network because the information is spread throughout the network. So we have an extremely high level of data security. blockchains are, since it is decentralized, there is always a so-called consensus mechanism when new data is added to the blockchain. This is nothing we need to understand in more detail now, or much detail now, but basically you have certain operations that make sense, or that make sure that only if more than 50% of the network participants accept the transaction as valid, so basically say they check and say, yes, that's correct, only then the data is added to the blockchain. And the beauty of that is that if you have 100,000 computers in the network, it is basically impossible to change the old data in the blockchain, because in the blockchain, you do not change the data, you add new blocks to the chain, which means the old data is always there. And that makes everything extremely transparent because it's always there. It's a little bit like the German registry for land ownership, so Grundbuch, where you cannot erase something, you basically just add a new entry. And in the blockchain, it's basically the same principle. And that makes it very transparent and virtually impossible to forge or to falsify, which also adds to this level of data security. In short terms, you access the blockchain because it's a network, as I said, through the internet. So it sounds a little corny, but the blockchain doesn't know any state boundaries. Yeah. So the network can be spread throughout the globe. And so also the applications that are running on this blockchain architecture can be offered throughout the globe. This is nothing completely new, because I mean, there is this thing called the internet anyway. However, the blockchain again makes it then much easier for participants of this network to interact. We'll come back to that a little later when it comes to applications. And as I will demonstrate a little or explain a little later as well, it allows the very nice term of disintermediation, which is, I'm in the finance business, so I'm a finance guy, extremely important because you are basically able, using the blockchain technology, to cut out, or at least to reduce, the number of intermediaries involved in financial transactions. I mean, some of us are in Australia, some of us are in Germany, and we all know how expensive money transfers are, right? Why is that? Because we have so many intermediaries. If we are now able, for example, with Juliana and myself, just to transfer, say, $1,000 or euro directly through the blockchain, this would be much cheaper and much faster than through the banks. And here we already see one of the key points for the blockchain. Now I said, I used the term, I could transfer some money to Juliana. Well, it's not that easy, but basically this is the functioning principle. In a blockchain, we call these things transactions. So how does this work? Keep in mind, blockchain is simply a database. Whether it's decentralized or not is not important now. Users, we call them nodes, become members of the network. And if you become member of the network, you receive a so-called public key. The public key is like your address or your name or your avatar or whatsoever. Some people compare this to a bank account number. And I think this comparison is actually quite okay. So you have a bank account number. So you're not known to the blockchain by your name, but by your bank account number. And you also receive a so-called public key, a private key, sorry, which the name already suggests is private, so only you have access to it. And these keys, private keys are usually, or public keys and private keys are usually then stored in so-called wallets. And wallets is basically, the wallet can be a piece of paper where I write my private key, or it can be a service provider who's offering these services, like having a strong box or something like that in the back. Yeah, but it's important, this combination of the public key and private key is important. Now, we could, for example, now say, let's just create like a table or a list of storage numbers, and we allocate each of these storage numbers to certain public keys. So one to my public key, one to Michael's public key, and one to Juliana's public key. Good. What we could do now, I can now say, I transfer my storage number to Juliana. And I can do that by signing or by authorizing this transaction using my private key. So I'm basically sending Juliane some storage number in the blockchain. That sounds totally ridiculous. But what we've just done is we've just created a Bitcoin. This and nothing else is a Bitcoin. So, and these little storage numbers that can be transferred virtually are called tokens. And that is the main functioning of the blockchain these days, in particular in the finance area. So what we can do is basically we have nothing but a table with different files. And the blockchain basically says, who does this number now belong to my public key or to Juliane's public key, and so on and so on. And this is called tokenization. And the new owner of this field is then put into the blockchain as the next owner. So virtually what we have little tokens that can be transferred between the users. But technically speaking, there is no transfer. It's just a protocol or list that says, ooh, this storage space is now with Philip or with Juliane or with Michael. So what we've done now is we have just transformed a database into a system that can create virtual transfers between the members. And that is what Bitcoin is. That is what Bitcoin is. Bitcoin was the first application of the blockchain. There was this famous or infamous paper from the late noughties, written by a guy or a group of persons under under a pseudonym called Satoshi Nakamoto. The funny thing is now, what you can also do is you can say, look, whoever owns this storage space has a certain right in the real world. So I could, for example, say everyone or anyone who holds this storage space or this token receives 0.5% of my company's revenues, which makes this token something like a stock or a bond or something like that. And this process is called tokenization. So you have basically two options here. Either you just send these tokens around, this is what without them having any real value in the world, and that is the Bitcoin, or you attach these tokens, or you attach to these tokens certain real world rights. And this is actually where it gets really, really interesting. And this is what has attracted the interest of, well, of the whole finance industry and also regulators, policymakers, and so on and so on. Yeah. So this process of tokenization transfers a database that is particularly decentralized, particularly safe, and notoriously difficult to control, or to not to monitor, but to control by a single regulator, into a system for transferring goods online. And that is a game changer. That is a game changer. And it's very important for me to explain that this is not just about Bitcoin. This is one of my favorite quotes or favorite memes on the internet. Peter Schiff is a very, very famous investment banker and advisor. He's one of the gurus in the scene. Just have a look at it. So this really exemplifies or demonstrates that the whole blockchain scene, which is very often seen as the same as the Bitcoin scene, it is not. Blockchain is not Bitcoin, it's different. But that this has really become some kind of religion for certain people, in particular for the younger generation. So now that we've talked about this background, think about the rumors and things you've heard about Bitcoin. You may have heard that Bitcoin is overrated, or that there is the danger of a bubble, and that there is no real value behind Bitcoin. And technically speaking, it's true. Technically speaking, it's true. The Bitcoin doesn't have any intrinsic value. The only value it has is that other people, or that people basically expect Bitcoin to retain its value or higher value. So they basically expect to be able to sell Bitcoin in the future for the same price or a higher price. So technically speaking, it's possible that Bitcoin loses all its value. However, no one expects that to happen because there is very often the parallel to gold. let's face it, gold doesn't have high intrinsic value either. You can make jewelry out of it, okay. You can use it in some chemical processes, okay. But the reason why everyone thinks that gold is valuable is that it has been around for a few thousand years. Structurally speaking, there's no real intrinsic value either. Bitcoin was originally designed as a payment system. Yeah, so the initial paper about it was called a P2P system for transferring or for payment. Bitcoin these days is not really used for payment anymore. I mean, it's possible, but it's simply not really, it doesn't really make sense. It has been basically transferred into some kind of asset class. And this is actually quite exciting because we have basically created over the last year a new asset class. And if you listen to the media a little more closely, everyone and their dog, JP Morgan and what their names are, they've all now started to introduce services relating to Bitcoin. So we are really seeing some kind of revolution or evolution there in the financial system regarding assets. However, and there is the problem, such a decentralized network is very difficult to control and to contain. And this is, of course, what raises the doubts of the regulators, central banks, and so on, and a lot of conservative participants in the markets. Yeah. So if you read these things on LinkedIn or in the New York Times or whatsoever, we have these extreme position of Bitcoin profits and we have this extreme position of skepticism. The truth is probably somewhere in the middle. My personal view is that Bitcoin is a funny thing. Okay, it has become an asset class. Okay, but it's become quite a big asset class. But the interesting thing is not the Bitcoin. The Bitcoin is actually a rather boring application. The interesting applications are in the real world. So I give you two examples why this is, at least for finance guys, so fascinating. The first idea is, or the first example is real estate investments. Real estate investments, in particular now, are very, very popular. In Australia, they have always been very, very popular, even more so than in Germany. And real estate is quite lucrative. But the problem is, first, the investment object cannot be split. It can just be split between investors. I mean, you can buy a house jointly with your husband, wife, or whatsoever. You can, for example, also set up a company that then buys the house or the property. But this is getting very, very complicated, particularly on the German law. So it is not really possible to invest small amounts of money into real estate. And the second one is, these investment parts or these investment shares are not fungible, so you cannot really transfer them. Yeah, I mean, try to buy or sell a house in the German law. It's ridiculous. You always have to go and see a notary. But what could you do? You have an investment company that basically buys the property or finances the property. You set up your own blockchain, or you use a blockchain that's out there. That's usually the so-called Ethereum blockchain. And you hand out a so-called investment or security token. And the security token, or this token, basically says, if I am in possession of this token, I will receive a certain percentage of the revenues. The beauty of it is, what you can do is, you can split the whole investment object into, well, smaller tokens, smaller units, and they are fully transferable, and they're even tradable. So they can be traded at exchanges or stuff like that. They can be traded in different countries. So you've basically, by doing this, you have transformed the definitely most conservative investment object you can think of, German real estate, into something that can be transferred throughout the world. And for finance people, this is quite amazing. I've just read a PhD thesis on crowd investment in real estate. And there was an example that basically the cost of equity for an investor, or for a fundraiser to be more precise, can be lowered by 2 to 3% by using the blockchain technology. And if for a company you can decrease the cost of equity from 8% to 5%, this for us normal people, that's nothing big, but for businesses, that is huge. And the second example, I've already mentioned it, is disintermediation. So think about it. Think of companies. What steps do you need to take if you want to go through initial public offering at a stock exchange? Or how many intermediaries you have when you want to transfer money from A to B? Or how many intermediaries you have to involve if you want to buy a share in the stock exchange. You usually have 5, 4, 6, 8, or 10 intermediaries in this transaction, and all the intermediaries take their cut. So for example, if you want to list a company at a stock exchange, depending on how you do it, 10 to 15% of your emission volume goes towards banks, intermediaries, and so on and so on. 10 to 15%. I mean, raise 100 million euro and you have to pay 15 million euro to banks. That is insane, actually. By using the blockchain, you can at least reduce, maybe even cut out, but at least reduce the number of intermediaries that you need. And this totally cuts the cost of basically of finance or financing. And it also opens up. It totally opens up the possibility for investment. Because let's face it, if you're an Australian investor, what is your first port of call? The ASX. If you're a German investor, where's your first port of call? Frankfurter Wertpapierbörse. And in reverse, it's exactly the same thing for companies who want to raise finance. Using the blockchain technology, what you basically need is good marketing, a website, and then you can raise funds through the blockchain. So very small companies or companies who would never be close to stock exchanges simply because of their size and their structure are now able to engage in fundraising that is comparable to a stock exchange. Again, that is a huge game changer. But of course, it's also a huge problem because, as you know, the payment system and the financial markets, so in particular the securities markets, are strictly regulated everywhere in the world. If you, for example, want to engage in initial public offering, you have to draft a prospectus, which takes time and is really, really expensive. As soon as you're listed at a stock exchange, you have to comply with certain rules of disclosure. There are the bans of market manipulation and insider trading, and so on and so on and so on. So what has happened over the last 2 or 3 years? There was actually one big question that kept myself and quite a few other people around the globe busy. And the question was actually, if we have such a token, does the token, when it's issued, does it give certain rights that are comparable to the rights of an investor? So do they provide for a certain flow of money or something like that? And if the answer is yes, and it took some years for everyone to accept that, if the answer is yes, then, at least in the European Union, these tokens would be considered transferable securities, with the result that the whole bulk or the whole array of financial markets regulation applies to them. This was a huge shock to the whole tech community because they thought, oh, we all thought it's not regulated. Well, of course it's regulated. If you meet the statutory requirements, then you guys are regulated. Congratulations. But it also provided for a transformation of the market. The whole blockchain market was like the Wild West at the beginning. And this is always the case for new technologies. At the beginning, it's always Wild West, and then regulators, policymakers step in, and so on and so on. But what we see now is that more and more established traditional companies try to establish fundraising, payment solutions, and so on through the blockchain. I don't know if you saw the media, MasterCard just announced yesterday that they will now allow blockchain-based transactions through their cards or through their system. And that's a game changer. That's the second biggest credit card payment network that now basically says, we accept the blockchain as a safe matter of, or safe way of transferring funds. So it's not the Wild West anymore. But now the question is, what happens if a token does not convey investors' rights? And then we're talking about something that is vastly unregulated. For example, the Bitcoin. As I said, if you buy a Bitcoin or a part of a Bitcoin, it doesn't give you investors' rights. You don't get money from a company. You just hope that it's more valuable in 2 days. So there are no rules regarding issuing tokens like the Bitcoin or other kinds of tokens that do not function comparable to shares. And this is where I started at the very beginning of my talk. This is currently happening in the European Union. So there's this huge project called the Market in Crypto Assets Regulation, where the European Commission has drafted a very, very bulky regulation to deal with these kinds of tokens. And in particular, also covers tokens such as the Bitcoin, and now it's getting political, asset-backed tokens. An asset-backed token, my dear friends, is what Facebook tried to introduce. What Facebook, and this is a huge problem, at least I see as a huge problem, the Bitcoin or the blockchain technology also gives companies the opportunity to establish payment systems outside the financial markets or outside the central bank system. This is actually, in my view, okay. But as soon as we have a company like Facebook with 3 billion users, that could really create a payment system that is fully out of control, and not just fully out of control of the central banks, but under the control of a single enterprise. And this is, of course, where all policymakers start saying like, oh, hang on a second. So what happened? This draft was introduced, and 3 or 4 weeks later, Facebook changed their name of the token they wanted to issue to D, and another few months later, they basically said we put the project on hold. And this is a good example of if a big economy like, for example, the US or the European Union say we want to do something about these developments, and so with social media and big tech, it has an impact. And this is currently in the pipeline. When it will probably come into force next year. We are currently releasing actually a book exactly on these questions. I could just kick myself because I should have advertised this more strongly, where we do comparisons throughout 20 different jurisdictions, and you can see this process in all jurisdictions, as well in Australia. In Australia and New Zealand as well, the regulators and the policymakers are actually trying to find out what the best way of approaching, or the best way to approach these blockchain-based payment system and investment system actually is. And Australia is, we have to admit that, one of the leading countries in this regard. So I've now just given an example from the finance industry, because, well, that's my trade. What are the next questions? The next questions are, will we have a central bank digital currency, so which is referred to as the digital euro? I'm pretty sure about that because China is already trialing these things. So they already have set up a system, which of course has a completely different flavor to it. If we talk about the blockchain, we talk about transparency and so on and so on. In the Chinese system, transparency, of course, means something very different because it means surveillance. Because transparency also means you can monitor. So this is so this is the obvious reason that the Chinese government is pushing these things so hard. And I think it's a question of not just of technology leadership, but also of competitiveness, that the US and Europe come up with their own solution to this digital currency, simply to counter what the Chinese are doing, what private entities like Facebook are doing, because the benefits from a digital euro would be immense. The efficiency gains would be breathtaking. But of course, a lot of banks and so on do not like that because they would simply lose this thread of income. The next thing that is currently under decision or under discussion, we need, or I said earlier, blockchain is basically an infrastructure. So you have the blockchain, or you have different blockchains, and then you have programs, protocols, and so on that are based on this blockchain. However, the blockchain depends on certain features like, is the programming, is the code solid? And are there enough decentralized participants making sure that the blockchain works? Or in other words, infrastructure needs to be maintained. I mean, if we have streets or an electricity grid, that's also infrastructure, and you need rules for that. So the next thing that is under discussion is whether the European Union or for example, Germany, they create their own blockchains for certain purposes so that companies have a reliable infrastructure they can use. Because if you start using a blockchain today, it's not exactly sure whether this blockchain will still operate in 10 or 15 years. We simply do not know. And that's, of course, a high level of uncertainty. And if there's one thing that businesses don't like, it's, well, uncertainty. Yeah. I've actually talked to some guys in the German Ministry of Justice, and they said, look, it is actually under consideration to set up like blockchain made in Germany as an infrastructure. And the idea is then to attract technology-based companies to Germany. Next big thing, I'm actually currently supervising a PhD thesis on that one. The idea of blockchain, of course, raises questions of competition law. Because if you have one big blockchain, like for example, Ethereum, it will have a significant market size or a significant market share. What happens if blockchain operators start to abuse this power they have? What happens if they start charging prices that are too high? What happens if they start discriminating certain kinds of users or businesses? So that's a huge question that hasn't been answered, because the idea of a decentralized organism that together has huge market power is something that is really incompatible to our idea of antitrust and competition law. And the very last thing that is currently under discussion is digital autonomous organizations, or DAOs. This basically means you create a blockchain using smart contracts, and you create a certain protocol or certain functioning organism that does certain things when certain other things are met. So it's like an automatized or automated structure. And this automated structure can then hold or own digital assets, such as the Bitcoin, without human control. And this is why it's called autonomous. And this is something very comparable to a company, but there is no human behind it. It's only the guys who wrote the code, and that's it. And this is something that is completely incompatible with our understanding of how to run a company, because you always need someone who's responsible, be it the management or the shareholders or whosoever. Yeah? And this actually doesn't sit well, huge discussions. And I just read a week ago that Australia is considering putting a version or something like the DAO into the Australian Corporations Act, which would be quite daring. I mean, but I haven't really taken a closer look at it, but that's really a bold step. And I haven't heard of any other country who has actually done that so far. Well, that was the rundown of what blockchain is actually used for in the financial markets and what's on the horizon. There are a lot of other things, like we could talk about anti-money laundering, we could talk about blockchain energy consumption and so on, huge topics, but well, I've talked for 35 minutes now. I didn't want to make 2 hours. So thanks a lot for your attention, and I'm very happy to take more or less any questions.